Hey everybody, welcome to our April webinar. Thanks for joining us. As I said, month on month, our numbers keep growing, so I must be talking about something remotely interesting, which is fantastic. So thanks everyone for being on time and joining the call. Lots to get through this month again. So for those of you that haven't joined our calls before, my name's Jonathan Wu. I'm the Executive Director, co-founder, as well as the Chief Investment Specialist for Premium China. So jumping straight into it, our standard disclaimer. Now the first thing is to remind everybody to register if you have not yet to our lunch, if for those of you who are in Sydney for our road shows for our road show, our one show this year, which is Tuesday the 1st of June. From 12 to 2. For those of you that are in Sydney, we are running it live at the establishment and then live beaming in our Hong Kong team. So we're putting on a nice lunch. Establishment is always great. And we always get 100 or so advisors to that, which is fantastic. So it'd be great to see you all come along for that, because it's been a long time between drinks and a long time between lunches. So come along, catch up with your peers, and it'll be good to see you guys mingle with other advisors again. For those of you who aren't in Sydney, we can register for the live stream. After the end of this webinar, you will receive a follow-up email, and that follow-up email will also include links. A link to register. That same link is to register for live show, or you'll have the option for you to register for the live stream. You also get another link in that email as well if you want to join this afternoon's 2:30 webinar on fixed income markets as well. So we'll have CPD points pending regardless if you're live or on the live attending it in person or on the live stream. With the live stream, as I said, based purely on compliance reasons, you have to be present for at least 80% of that time period between 12 and 2, which we'll be tracking in order for us to then award you your CPD points. So just updating the chart that we talk about each month that advisors want to keep up to date on in terms of our track versus the platinum track, given that our fees are now cheaper than platinum. What has our performance shown? So year to date, we've outperformed them by about 200 odd basis points net of fees. And since inception, which is now in its 11th year, we have outperformed platinum in 8 of the periods. It is obviously very acceptable and understanding that because they are also a long short fund, they're also a multi-currency fund as well, so they're adding a lot of bells and whistles to generate returns. We try to keep things as simple as possible and don't try to complicate things, and then obviously we don't feel that we want to have to explain the different ways that the performance of the fund is attributing over time. So there's that. Just an update, we're still working on Colonial First Choice as well as Colonial First Wrap, and we'll see Wrap should be coming to a decision reasonably soon, and that one looks quite positive, so watch out for that. That will appear both on the Navigator platform, which is the historical platform, as well as MLC Wrap. And for our friends over the ditch in New Zealand, it is also available on both of your major platforms, being Aegis as well as First New Zealand, or FNZ for short. So my standard chart here around, the seesaw of the world that we see. Obviously, one side opportunities, one side risks. One thing I'm going to talk about today is the issue around finding ways to invest directly into A shares, because this is certainly the future and the future of investing in terms of what we're going to see, this proliferation of people trying to find attractive valuation equity markets, but at the same time trying to get into markets early on, not so much as a satellite, but really as part of your core global equity foundations for your clients. And I think the other thing to note is that you can't blindly go into A shares. It is a difficult market to access from a regulatory perspective, but at the same time, it's also difficult to research. So you really want to find teams on the ground that have had a track record of building relationships with listed companies inside China. So I'm just talking specifically the A share market, and then have been able to translate those into returns for your investors. So just keeping everyone updated around our investment manager, Value Partners, headquartered out of Hong Kong, managing $13.4 billion, which is effectively $4 billion in fixed income and about $9-ish billion in equities. So we, and the key point to note for those of you that join our regular webinars is that 43% of the company's equity is still owned by management and co-founders, alongside our portfolio manager, Renee Hull, for both the China as well as the Asian fund. So this alignment of interest, really, really important. And that's obviously what we set out to do 16 years ago, is to find a boutique manager that was going to be hanging around for a long time. We're not so interested in institutional level fund managers where they don't have that strong alignment. They're just remunerated on a base package plus a bonus, and then they don't have that tie-in with the company. So with our 70 strong investment team, that's effectively how we're going to get the bottom up, how we're going to complete those 6,500 company visits for you, and then find those best of breed ideas. And given the fact that we're not a trading company, the investor relations teams within Asian Equities broadly, and especially in China, they really like talking to us because we're not going to be going and trading out their stock. We're sort of buying and holding. Obviously, over time, we trim and add depending on valuations because we have very strict discipline with regards to that. But overall, IR companies, IR teams love talking to our investment team. And that's the other important factor when you're investing in a region like China and, of course, broader Asia. So reminding everybody that one of the key things from a Chinese perspective is that, and this is a trend that's going to keep going for the next sort of 10 years, is that the transformation of China is going from being a supply chain of the world to being the demand chain of the world, where in a supply chain environment, you're the guys that are being dragged along. You are being commanded in terms of what price you can sell it at. You don't have much wage growth, and because you are a cheap country to manufacture goods and services in, you obviously have a high prevalence of poverty and a lack of a domestic market, which is one of the key drivers of what happened to Japan, its demise, when the US effectively attacked the country from a trade perspective. The US has been attempting to do that with China and will continue to do so, but what China has in its power now and what it's been able to do as part of its transformation for the last 20 years is fundamentally build up that domestic consumption story. And that's the one you keep hearing about and will continue to drive the economy forward, which will create sustainable, high quality growth, not growth for the sake of growth. And if we sort of consider that in the context of COVID, if you look at the total amount of stimulus, and this is a very, very important point to remember, the total amount of stimulus deployed as a percentage of GDP, Japan was the highest. It's about 56%. These are numbers ending the 1st of April. The US is about 26%, inclusive of the most recently passed $1.9 trillion stimulus package through Congress. And in China, it's about 4.6% of GDP. Okay, so China learned a lot of lessons post the GFC, which was caused by the United States primarily, is that if you overstimulate your economy, you then create a whole lot of excesses that you then spend years later trying to rein back in. In Australia, where about 15 to 20% of GDP is our stimulus package. And if those excesses continue, we will see issues where the government will have to address later down the track, when China's been very fortunate to be in a strong fiscal position to be able to defend against those situations. And as I said, that sort of culture and value then also stems down to Asian corporates, which have the strongest free cash flows in the world and also has the lowest net gearing ratio. So very well prepared for any crisis that is going to hit their shores. So in terms of earnings, what's important if we consider what we like to call the year of normalization is that a lot of people, sort of sent me emails or messages and said, oh, China's growth rate for the first quarter of this year has been awesome. It's 18.5% or whatever that may be. Oh, yes, it's missed estimates by about 50 basis points. What do you think of that? For us, reasonably irrelevant, mainly because of the fact that you've got a base effect. Okay, and every economist is talking about this base effect. When your economy contracts or the rate of growth because of COVID has been significantly constrained, you then have to consider, well, if you go back on a normalized rate, if you compare first quarter of this year versus first quarter of last year, because quarter one was the biggest impact to GDP with China for, I think it was something like 40 years or something, since quarterly numbers were released, it was negative 6 point something percent. I think it was about 6.8%. I don't remember these figures so clearly because they're irrelevant to our investment process. But then you go, okay, first quarter last year contracted 6.8%, first quarter this year expanded 18.5%. Oh, that's fantastic. Well, we don't think it's fantastic. We're looking at more of a year on year. But what's important to note is that if you consider from a GDP growth rate, China last year had no contraction of earnings, which is important to us. Okay, they didn't have a contraction in growth overall either. Okay, which is fantastic to see, which means that you're coming still off a base that keeps on growing. Okay, so whenever you see first quarter GDP figures come out of places like Europe, especially probably more so for second quarter, because really second quarter when lockdowns sort of became more prevalent, economies came to a standstill, human movement or the mobility of people came to an absolute standstill, more so in the Western countries for about quarter two, and that's going to be interesting to see because the bounce back's also going to be pretty much V-shaped. Taiwan is the other standout point. No contraction in the economy, no contraction in earnings. Okay? And in actual fact, earnings last year will be stronger than the earnings profile for this year because Taiwan is very much a tech-centric country, which we're going to talk about a bit later on because we're going to dissect and talk about the export market in Taiwan. So for those of you that follow the overall Chinese political environment, there was their National People's Congress meeting. And so one of the things that most people don't know is that there are about 3,000 members of parliament, is probably the best way to put it, inside China, that is made up of their NPC that talks about what are we looking to achieve for the country. Now, since about 1940, something about post-World War II, China started going down its 5-year plan. And this is the strategy that they use to say, what are we going to do in the next 5 years? Which is a very different approach to Western democracies where they're just basically planning stimulus and policies based more so on an election cycle. So therefore, you know, if I use an example just locally here in Australia, and every year, you know, through a coalition government, at their budget, they always talk about, oh, forward estimates show that by 2026 we'll be in a budget surplus. Well, that's really a throwaway statement, isn't it? Because the fact of the matter is that it's irrelevant because you're most likely not going to be in power by that time. So whatever you talk about now that's forecasting something out that's 6-7 years away is pretty much irrelevant. But in China's case, it's not. The populace, right, and the 92 million members of the Chinese Communist Party hold their government to account. And at the end of the day, what China is trying to prove and trying to provide for their citizens is not top-line growth. Top-line growth is irrelevant. There is no investment thesis of wherever you are allocating clients' money towards, right, in terms of providing them growth on their investment savings, is not driven by GDP growth, which is simply why it is not relevant for our conversations when we do our webinars or presentations. It is completely irrelevant. Okay, what is important is the expansion of wealth for the Chinese populace, expanding the domestic market. As part of that, China is now dedicating 7%, in excess of 7% CAGR growth, and committed to do that on R&D. So even if we look at 2020 figures and even 2019 figures, China is registering more patents than the United States. And that's something to be very, very aware of because there's always been, you know, this talk around China, you know, being subject to intellectual property theft, so on and so forth. But China is now trying to enforce its intellectual property rights globally. Okay, and furthermore to that, China is currently taking countries to the WTO because it has grievances against them. China in the last 20 years has been lending so much money to so many countries because they need it to lend them a hand. And a lot of them are now not even paying it back. So China is actually using the global set of standardized rules, which they follow, and they do not take unilateral action, unlike the United States, in order to enforce the rule of law globally with regards to trade. And that's something very, very important to see, because they do not take unilateral moves against countries that owe them money, right? They do not provide sanctions. They are there to use a mediation process that is well understood and accepted by the global community. Furthermore, the way that the Chinese government is developing its populace is going down more of a socialist path. What we mean by that is, in about 2009, China's stimulus package was very much focused on three things. How do we generate a sustainable retirement pension system? How do we create co-contribution systems like superannuation that we have in Australia? How do we provide universal healthcare for everybody? And then how do we provide universal education for everybody? Tick, 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 11 years on, we're there, okay? So China is continuing to go through go through their plan, increase and continue to improve on urbanization. And as long as wage growth is faster than house price growth, then we're all good. And this is the funny thing that we always get. Since the umpteenth of time, since genesis of our business in 2004, everyone says, oh, China's not sustainable because China's got really high debt levels. Well, the rest of the world has got high debt levels now, but no one seems to be concerned. China's property market is out of control. We shouldn't invest in China. Or there's pockets of Asia where Asia's property market is booming way too fast. It's growing too fast. Wages are not catching up. We won't invest in those countries. Why do we invest in Australian equities if we have house prices that are growing faster than wage growth, where wage growth has been stagnant for 8 years? Okay, you have to disconnect headlines with the reality of investing, and you then also have to disconnect the headlines away from active investing. I can sort of understand that you may have an issue with index investing, and that's why in Asia, if you index invest, you have seen the outcomes. It is not pretty, and you are subjecting your clients to incredibly high levels of volatility. But the reality is, for us, we're focusing on active investments, which is why GDP growth is irrelevant, right? From a macro perspective, we care about the 6,500 company visits, of which we did over 8,000 last year, to get you those best of breed ideas. So we've got more than 10% allocation of both the China fund as well as the Asia fund in A shares. Now, what I'm showing everyone here on this chart is why a long-term allocation to Chinese equities will be good for your return profile. Okay? What you see on the left is the total assets under management for mutual funds invested in Chinese equities as a percentage. So this is locally, as a percentage of the nominal GDP of that country. Okay? So United States, I mean, that's no surprise. Proliferation of equity markets and equity funds. You have 181% is the mutual fund market, right, of nominal GDP of the United States is invested in those equity markets, right? You compare that against global, it's already at 100%, but in China, it's 87%. Now, that may not be that stark, but if you look at the right-hand side and look at the household asset allocation profile, if you look at the United States, 22% of household wealth is invested in equities and mutual funds. In China, it's 2%. So despite all this talk about, oh, the Chinese retail investor treats the market like a casino, and it creates the underlying volatility, that's fine. Because over time, the household asset allocation is going to increase because it's going to shift away from real estate speculation, which the Chinese government has been very, very key, right? Even in their most recent NPC 5-year plan, they've stated clearly, property is not for speculation. Property is for housing people. And as that sort of government mandate sinks into everybody's minds, they're going to diversify away from real estate. Okay? And when you then stack on the mutual fund market's growth inside local China, the insurance companies, which are also increasing their allocations to A shares, which is why, as I talk through the portfolio a bit later on, I will talk through some of those themes that are flowing through within our portfolio. This is why having Chinese equities, active Chinese equities specifically, in your portfolio is critical. Okay, absolutely critical. Then Taiwan, which is other quite high tweak in our portfolios at the moment. This is their export markets. Okay, so we've all heard and understood about the total shortage of chips in the world, mainly driven by semiconductors. And if you consider, like since the late last year, even a company like Apple has struggled to bring out a whole raft of new products and make it globally available until their announcements yesterday for new iMacs and a couple of other devices, is because there's a chip shortage globally. And this is not going to be fixed in the next sort of 6 months. There's an ongoing lag situation, right? If you look at cars at the moment, massive problem there. You can't get a car manufactured, custom ordered, solely because there is not enough chips in the world. Okay, so there's going to be this demand and supply issue, or supply side issue. Demand keeps increasing because we're working from home. The webcam that everyone's viewing my face on right now has a semiconductor inside of it. Okay, so all these things has led to Taiwan, which is a massive exporter of these components. It's just gone gangbusters, absolutely gone gangbusters. Okay, and Korea, for us, because we believe the global economy, even with the hiccups around vaccines, vaccine efficacy, so on and so forth, Korea is a great country from a market beta perspective. Okay, so because Korea is very subject to the external market, very similar to Singapore in that sense, but Korea has a much broader capital market for us to invest in. Korea's growth and the earnings revisions this year has driven us to also have a strong allocation into Korea within the portfolio, which we'll see in a minute. Now, the stock story that I want to talk about this month that is now sort of starting to appear in our top 10, mainly because of price performance, but at the same time our conviction has increased, is a company that we followed for the last 15 years, right? But the way that the Chinese consumer is viewing these opportunities has also changed. Okay, and what I mean by that is that the younger generations now trust the domestic brands more than the foreign brands, because they've grown up in an environment where the domestic brands are very prevalent and front of mind when it comes to the advertising campaigns of these businesses. So Xiaomi, local milk production, DJI drones, and Ning. And so this month we're going to talk about Ning. Okay, so Ning is basically the Nike of China. Okay, it is a massive beneficiary for the upgrade of the healthy lifestyle trend in China. Okay, so exercise brands wise, Ning is top of the pops. Okay, they have a number of sub brands within the market. The most recent time that we have entered into Ning was December of 2019. You can see that its share price corrected quite significantly as when we bought it. Since we bought it in at about $100 a share, it dropped to sort of $25 a share, and then we just kept building up the position. Okay, because apparel in China is growing very strongly. One, because everyone wants to wear Nike. Okay, and second of all, the healthy lifestyle is just going to increase. And when you've got the middle class growing in terms of the disposable income, they want to be wearing Nike. Okay, so share price performance has been very, very strong. And the share price is now at about $350. So that's sort of appearing in the top 10 for our China fund. It's not quite within our top 10 for the Asia fund yet. But the key thing for us is, based on our modeling, we believe the CAGR for underlying earnings growth is somewhere between 30 and 40%. Okay, for the next 3 years. Okay, which provides us a lot of conviction into how we can capitalize on that for investors in something that is not just technology as a pure technology play. So I've just replicated the chart there of us versus Platinum. That's all our most recent research ratings. SQM released their refreshed 2021 research about a week ago and maintained our superior 4-star recommended ratings. Zenith and Longsec also maintained theirs as well, so all good. Keeping up to date with everyone for figures ending March. Performance-wise, we've always talked through that, and that's great. But what's most important is how much risk are we taking in order to generate those returns for you. Okay, risk in isolation is not a decent metric. It depends on how much risk you're taking to get the same sort of return. Sharpe ratios and information ratios is great for that. So the higher the number means that the more units of risk that you're taking, you are getting way higher levels of performance. So under all time periods, 1, 3, 5, 7, and 10 years, because we have such a long track record run on this fund, our Sharpe ratio is off the charts, and so is our information ratio, especially if you consider that over a 5 and 7 year period, our peer median information ratio is actually negative, which means that you're taking excess levels of risk in order to generate inferior levels of performance. And that's something to really take into account. Performance in isolation, risk in isolation are not good metrics in order to measure whether the quality of fund manager. And for those of you on the call that have known me for years, I'm still a financial advisor, and therefore I research funds every day of the week as well. So in terms of our Asia fund, what you see here is in terms of that new economy space, it's making up about 60% or 2/3 of our portfolio, mixed between IT, consumer discretionary, and communication services, and then sort of about the same amount across Hong Kong, Taiwan, South Korea. You then add in A shares, red chips, and H shares. We're pretty much sitting at around 80% of our portfolio is in Northern Asia, which is Korea, Taiwan, Hong Kong, as well as China, okay? Because we still, again, have the strongest earning optics. We have situations in the Philippines, Indonesia, India. There's no optics on earnings, solely because COVID is still way out of control. And there's nothing that interesting for us to be invested in Singapore at the moment, compared to, say, someone like Korea. So if you look at our top 10 holdings here, as you can see, Tencent, the sort of the, you can say, bank communications company, sits at the top of our holdings. The two largest chip makers in the world is still our highest conviction names in Samsung Electronics and TSMC. And then we don't have a holding in Alibaba at the moment. We think there are significant headwinds for them at the moment. The price doesn't justify it. We think it's a great business, and I think that's something to be very, very clear. We think the ongoing growth for Alibaba is going to be on a very strong trajectory. We just don't think the headwinds justify the current price. So when we see another strong correction of Alibaba, we're going to reconsider going back in, but at the moment we're not all that keen on that. So we have Pinduoduo and Meituan, which is sort of sitting in that space, that basically directly competes with Alibaba. That's where we're holding at the moment. And for such a strong sort of tech new economy sort of portfolio, the PE is sort of 17 times versus even just broad US equities sitting at 25 times. And you can also see here over the last 12 months, we update this for everyone every month, is where is our attribution? Where are we making the calls to generate the portfolio returns for your investors? This is the China fund since inception, obviously a great 15-year track record throughout its history. And then in terms of the exposures, again, around half the portfolio is new economy, a bit more than that, about 55%. But we started getting into a bit more value plays here. So you'll notice that we've got about 11% in banks. And that's quite interesting because we're interested in that sort of value play inside China, where banks are still going to be primary lenders. And also on the back of that, we also have insurance companies, which is going to benefit on the back of increasing investment into A shares, okay, or the premium bucket within the insurance company is going to invest more into A shares. So you can see here, Ning is our 7th largest holding within the China fund, but you can also see AIA Group has crept into our top 10 holdings. Okay, so insurance companies invest their premium dollars generally has been a very conservative manner. But what they also do is that a decent chunk of insurance earnings actually flows through from their investments. And the Chinese government is allowing more insurance companies to get access to direct A shares. And then obviously the insurance companies are then taking part in that. So for us, we think it's a great value play. And as well as China Merchants Bank, you can see here, that's about half of our bank exposure within the portfolio. Again, banks had a bad time last year. We think it's a good value play getting in now. And so is Galaxy Entertainment Group, which is one of the largest Macau gambling plays out there. And again, coming off a low base, we think Galaxy is a pretty good value name for us to get into at the moment. So just a bit quick marketing for our 2:30 or 3 p.m. fixed income Sydney time webinar. Rates are really, really low. That's a global phenomenon that everyone sort of pretty much understands. The problem is, the question is, should you be buying bonds now? And at the end of the day, it depends. It depends on what? it depends on what you're buying. So while you may be marketing to your client that you have great cash yields, offering them here at 2.86% and 1.48, and you say, oh, Mr. and Mrs. Smith, that's still better than a term deposit, you haven't factored in the fact that they're going to have a capital loss every year for Australian government bonds for at least the next 6 years, international bonds for at least the next 10 years. You cannot backward look on performance to justify an allocation to government bonds at this point in time. So what we're offering is that we're buying bonds less than $100 in value. If you want to buy more things that are more than $100 in value and only getting $100 back, that's where you factor in your capital losses for the next 10 years and for the next sort of 7 years. And what we're saying is we're going to generate you a cash yield of about 7.5% with a yield to maturity of 8.3, meaning that we're generating about 85 basis points of capital gains. And we've really brought in that time to maturity. What's been very interesting, and something that I'm going to be covering off at our webinar on fixed income later on this afternoon, is this problem that overseas or Western research houses, being Moody's, Fitch, and Standard & Poor's, have now proven again that they do not understand how to research fixed income instruments. And that's very important because that's how we gain our competitive advantage to actually generate the returns that you can eyeball your clients and actually say, I'm adding value to you. So please join us for that webinar. As I said, you'll get a follow-up email after this, inclusive of the link to register for our roadshows on the 1st of June, and as well as a link to register for our fixed income webinar later on this afternoon. Here are our details for both me and Derek. And for those of you across the ditch in New Zealand, everyone has Clayton's mobile number. So thanks everyone, short, sharp 30 minutes. And then I hope to see some of you later on this afternoon for fixed income. Thank you.